So what we did was we looked at 1,000 residential transactions, and what we found is that 6.7% of those 1,000 people waited so long that they missed out on deductions. And what we did is we calculated the average losses that each of those people in that case came to. It was actually $20,537 was the average amount. And if you extrapolate that over the investor population, we're talking $2.88 billion worth of deductions.
Welcome to Get Invested on the Property Hub podcast channel, the leading weekly show for Australians who want to learn how to unlock their full self, health and wealth potential. I'm your host, Bushy Martin, and each week I go deep with the best investors, experts, leaders and founders to find out what it takes to break free from the grind, discover freedom and to live by design. Subscribe now and join me and get invested in the life that you really want. Let's get started.
Hi freedom fighters, and welcome to this week's Property Hub Get Invested episode, your podcast that deep dives into the minds of Australia's most successful and respected investors and advisors that uncovers the surprising things they do when no one's watching, like reading tax legislation for fun. And yes, they do exist. And today's guest is actually one of them. But before we get into all of that, let me ask you a couple of questions. Are you investing in the right property, in the right place, in the right structure, or just hitting and hoping for the best? Are you leaving thousands of dollars of tax deductions on the table every year, while the ATO quietly rubs their hands together? And where do you sit when it comes to the hidden magic of depreciation? Do you really know the difference between claiming capital works or just getting capital worked over? Because if you don't, you're not alone. And that's exactly why this episode could mean the difference between your portfolio running on rocket fuel or burning a big hole in your hip pocket. Now, let's be clear, success in property is not just about bricks and mortar. If you've been listening to me for any length of time, you know that it's a game of finance and a game of affordability. And in today's high-cost, high-risk environment, long-term cash flow affordability is the real key to sustainable success long-term and lasting long enough to enjoy the fruits of your property labour. And that means making every dollar count, especially the ones you don't even know that you can claim. So if you've ever lost sleep wondering whether your investment property's door handle is tax deductible, or you just think quantity surveying sounds like something a Mr. Bean Bond villain might do between world domination and attempts, then today's episode is going to be an absolute treat. So to set the scene, let's paint the picture with a little tale I like to call the curious case of the cash flow black hole, where two mates, Hamish and Andy, both secure investment properties, same suburb, same street, same purchase price. But within 12 months, only one of them is getting sleep at night. Hamish built a brand new home, energy efficient with depreciation schedule locked and loaded. Andy bought a charming 1980s fixer-upper with character, and as he found out later, a leaky roof. Fast forward to tax time, and Hamish gets between 10 and 15 grand in deductions, while Andy, just a pat on the back from the ATO and a head to repairs and maintenance bill. Hamish's property gets close to paying for itself thanks to lower maintenance, smart tax structuring, together with PAYG tax variations that drastically reduce holding costs while improving cash flow affordability. Andy's, well, his yield is mostly emotional trauma. So what makes the difference? It isn't just luck or location, it's tax savings and depreciation, those silent sleep-at-night assassins of your holding costs. And here's the good news. When you buy new build homes on infill blocks in tightly knit lifestyle-rich locations that are primed for gentrification, new infrastructure, new industry diversity and rising incomes, not just buying growth potential, you're buying maximum tax efficiency and affordability, as opposed to old character properties that make your wallet weak for the next 15 years as you try to survive on a diet of toast and 2-minute noodles and are stuck at home watching endless reruns of Get Smart. But you can only achieve improved cash flow affordability if you know how to unlock it. And today's guest, well, he's your master locksmith. Because joining us again is the man, the myth and the spreadsheet whisperer who knows more about depreciation than most of us know about our own bank balance. I'm talking, of course, about the infamous Mike Mortlock, co-founder and managing director of MCG Surveyors, who you remember from Get Invested episode 161. So if you want to enjoy his backstory and depreciation basics, make sure you go back and have a listen. Because Mike's not just another humorless QS in a beige suit with a pocket calculator and measuring tape. He's a straight shooter with a data addiction and a laser sharp understanding of where property investors are buying, what they're getting wrong come tax time, how to squeeze every legal dollar out of your deductions before the ATO gets there first, as well as what's next for property investors around the country. And Mike isn't just your typical property tax and depreciation nerd. He's also an elite agent, top 50 influencer if his Insta pages still can't. He's a tech-savvy data hound. He's the host of the very popular long-running Geared for Growth podcast and an all-round good guy who somehow manages to make depreciation sound interesting, as you're about to hear. He's also on the board of the Property Investment Professionals of Australia, or PIPA, so he's not just talking the talk, he's helping to shape the industry from the inside out. And just in case you still think he's all numbers and straight talk, here's a little secret. Mike's the only QS who can make depreciation almost funny, make tax sound sexy, and compliance sound like a good time. He's the only numbers man I know who can make tax depreciation sound like stand-up comedy with spreadsheets. Think of him as a bit like the love child of Gordon Gekko and Warren Buffett. So if you want to know more to legally milk every dollar out of your investment properties and do it in a way that the ATO actually approves of, so that you can stop giving the taxman a tip and start getting serious about sustainable investing, strap yourself in, because this one might just save you thousands as well as a few grey hairs. So welcome back to one of Australia's most trusted property advisors, and let's get invested together, Mike.
Goodness me, that's got to be the best intro I've ever heard. I had to mute myself so the laughing wouldn't come through.
Well, I know you've got a great sense of humour, mate, and I'm so frustrated I get so little opportunity to have some fun with someone in this very serious world that we're in. And knowing that you've got a great sense of humour, it's just a too good an opportunity to miss, mate. So,
well done.
I think way too many of us take property far too seriously in this day and age. Yes, it's a serious topic, and yes, we're spending big money, but there's no reason why we can't have some fun with it at the same time, which is what I think you really bring to the industry, and on top of all the smarts that you share with us, mate. So I'm really looking forward to digging into some topics that are near and dear to both of our hearts today, mate.
Yeah, thank you. I mean, you've set the bar very, very high, but yeah, it is serious, as you say, but I refuse not to have fun. I think of that little girl with the tacos, the why not both, the crispy and the tortilla sort of one. Like, we can do both. Let's have some fun.
Exactly right, mate. I totally agree. Mate, you've done a lot of work recently and enjoyed it with interest. So I'd sort of want to start with the big picture a bit if we can. And I'd sort of want to dive into your recent March research report, as well as some of the in-house 2024 data that you've been uncovering that tells us a bit about where our investors are putting their money right now and why. So can you sort of share a bit of that, and what surprises, if any, have emerged from what you've observed with buying patterns over that time?
Yeah, so what we typically publish in-house is where property investors are buying around the country when they come to us for a tax depreciation schedule, right? So we know we have to inspect the property, so we know kind of where we're going. But our recent research project was more of a macro one. We were looking at properties that were sold within the last 6 months and looking at newly advertised rentals for the month of February it was. So we analysed 60,000 of them. So the idea is that, okay, something sold, and then we can correlate that address with a rental listing, so we know, that this is where people are buying. Interestingly, we saw 78% of people buying houses and 22% buying units. That's always a data point that we share with our data, but this is much broader and much more macro. And it highlighted some areas that we kind of knew were quite active, and I can contrast the macro data with our own data, but Melbourne West was definitely one of the top regions. It's in our top 20. The Victorian property market has been on the radar for property investors for the last little while, for a number of different reasons. One, mean reversion. Everyone's kind of obsessed with this idea is that, this is what it would have been if it kept going along the line. So eventually it has to jump, or, it hasn't had a go for a while. Like, it's like, property markets like waiting your turn on the merry-go-round. It hasn't had a go for a while. So it's its turn, I'm a bit skeptical of those sorts of notions, but certainly WA is very popular. We saw the Gold Coast attracting quite a lot of investment as well, which is quite interesting, but there are still some relatively affordable price points. And then, some of the repeat offenders that we've seen over the last couple of years, like Perth, southeast, definitely majority on the south, a bit of northwest, and even a little bit of Adelaide as well. So, yeah, that was quite interesting for us. And if we contrast that with our own data, where we looked at, last time we crunched this, we looked at 2024 for the whole year. And the number one actual location from a statistical area 3 perspective was actually Townsville. And that actually makes me quite happy, because anyone that's bought in Townsville in the last couple of years has made an absolute killing. It's been one of the best performers over the last little while. So it was actually number one. And then, if you go down to the next couple of ones, we're talking, Perth and Perth areas, very, very popular, like the Midwest and Rockingham. Also Gladstone as well, Mandurah, which is funny. Like, I can remember, I think it was in a current affair story some 4 or 5 years ago, with people buying in Mandurah and, basically losing their money and losing their life savings. And then, again, like, maybe the merry-go-round is right. You just kind of wait your turn. But yeah, typically it's those higher East Coast cities that are attracting a lot of attention in Queensland, and Perth. We are sort of seeing that kind of trickle away now, because you can see in the core logic numbers that it's well past the peak of the market.
Yeah, interesting. Yeah, I know the data is sort of a little bit historic almost, because we're sort of instant everything these days, but a lot of it looks like a bit of a revolving affordability catch up, as you sort of touched on there, that the reversion to the mean exercise. Do you think that's been driven by the increased profile of buyers agents and podcasts like ours to some degree, that we're either sort of focus in on those areas and therefore people pile in? What's your feeling on all of that?
Yeah, I think so. I think the marketplace has changed, and it's not going to go back to the way that it was. If you rewind, let's say 10 years, there's plenty of buyers agents around, but there was only a handful of what I would call the big scaled agencies, whereas now we've got quite a number of them, and there's new ones that are coming out each day. It's been an industry that's absolutely exploded. There's some positives and negatives in that, which I think we'll sort of touch on later. Yep. But it's not just these big agencies that they're research driven. They'll go into an area. They also have people that follow them as well. So the sort of the clinger on sort of buyers agents that follow. There'll be people that don't necessarily engage them, but they get wind that XYZ buyers agents is now buying in Darwin, for example. And, that's sort of based on a true story. We've also got these massive property forums and big podcasts with lots of following. So someone could say, look, I think this area has legs. And then suddenly you have tens of thousands of eyeballs. So the big question that everyone wants an answer to is, can that move markets? And I think the answer is yes, but there's a caveat. I think the population size really, really matters. So can a property forum or podcast or big buyers agents move the greater Melbourne market? No. But could they move areas like Townsville? Yes, I believe so. And I believe we've seen that to some degree as well.
Very good insight. I think that's the bit that is moving the needle, when the critical mass is of such a size that a big influx can start to shape things. Then we're seeing that sort of activity. I think the interesting thing from here will be, because I think we've all come off the back of a very unusual artificial period of time post-COVID. That I think has, for people who have suddenly got into property, that's all they've experienced, so that's all they expect. I guess I'm starting to see a bit of the pandemic petrol burnout, and I think it'll be interesting to see what happens over the next few years as we probably return to more normal style conditions. But the market moving activity, which we will dive into a bit later on, will be interesting to see what influence that has, because I think if the underlying fundamentals aren't there ongoing, then we might see very short burn and then flatline activity in some of these locations as the horde moves from one area to another. So I'll be watching that very carefully, I think, in the context of that sustainability.
Yeah. I think you've hit the nail on the head, and that's a big risk. And I wasn't necessarily thinking so far back as COVID, but it makes sense because my brain is kind of looking at what I call I'm going to actually make up a term now. We'll see if we can get it to take off. The Perthification of property investing. So you're right. Like during the pandemic, we had all the big banks saying, the property market's going to crash by 30%. None of that turned out to be true. In fact, it was the perfect time to invest, especially at the beginning where everyone was fearful. You can kind of think about, you called me the love child of Buffett before. So you could basically be saying, the tide was about to go out, or at least that's what people were thinking. But little did they know that there was a full moon coming in and it was gonna roar along. But why I'm sort of talking about Perth is that, in last year, it grew 19%. It had an even better year the year before. And people are kind of thinking, oh, this is property investing. Yeah, like I bought one in Perth. Okay. And I got, let's say 30-40% growth in 2 years. All right, well, where's the next Perth? And I think that's the big question on most people's lips that are relatively new to the property investment game now. It's like, where is the next Perth? And a lot of people were talking about Victoria. There's a reason why Victoria is in the toilet from a price point of view. As we know, like the economy is in big trouble. The land tax changes, the minimum standards legislation has not been a nice place for property investors to do business. But now we've got people looking at, okay, what's the next Perth? And there's a lot of eyeballs on Darwin. Now, I'm not here to say that Darwin won't have a massive 12 months. It could do extremely well, especially if I'm correct in this idea that property forums and buyers agents can move markets, because I can tell you they're already there. And the word on the ground is that it's fever pitched already. So the danger here is that if you look at Perth, Perth had a point in time where its median house price was higher than Sydney. I think people forget that. Yep. Perth had a median value in the 490s for about a 14-year period. Yep. And Darwin, I think, had an 11-year flat spot. So if you don't get your timing right, you have to be able to hold on to this asset that is going to be negative in cash flow. Of course, you can buy with a 50% LVR and hack those numbers yourself, but most people don't do that. So I'm saying most properties will be negative. So it's a matter of how long can you ride it out. I think we've become drunk on that sugar hit, and it is a strategy where you can pull that equity and go somewhere else. But at the end of the day, you need an asset that's performing over the long term. I really believe property is more of a get rich slow kind of scheme.
Right with you there, absolutely right with you there, and that's where I think the longevity of the exercise will become quite telling, because when someone's used to a sugar hit, if they're suddenly seeing flatline, plateaued activity, yes, they'll be getting some tax benefits out of it, great, but you and I both know that over 50% of first-time investors normally pull the pin within the first 5 years. And a lot of that, I think, comes down to the affordability piece. But also, if they'd gone in expecting this exponential or even linear growth in the price value, and that's not happening, and again, sadly, I've been around long enough to know that once you've gone through a spike, we actually often see prices settle back a little bit, say 5 to 10% for a year or two before it then sort of goes sideways until something new comes into the mix. I think that'll be the testing time. And that's where I think the new rush of buyers agents who have flooded into that market because of the low barriers to entry, that's when we'll really be able to pick the good ones from the bad ones. Because
and even some of the good ones, I can remember well before COVID, interviewing lots of different buyers agents and talking to them about mining towns, because if you want to find an area that's going to do the biggest amount of growth, and often it's one of these places. And, they're basically all sort of saying to me, I'm not clever enough to time a market like that, so I'll never invest in it. And then that's ignoring what the long-term fundamentals of it. And it really stuck with me is that, some of these people are the brightest people in the space, and they don't feel clever enough to be able to time a market like that. So what hope has anyone else got,
Yeah, exactly. And a lot of people have lucked it out in recent times because of the unusual and artificial forces that have been influencing property values. So I think that's where the fun will emerge. But we'll no doubt get back again later in a couple of years' time, mate, and revisit this conversation. But mate, let's sort of switch gears a little bit for a second and now sort of go back to your core in terms of what MCG is all about. And at the time of recording, we're edging into tax time where accountants start to sweat and getting used to not sleeping for a few months. So what should investors be doing right now to avoid some of the common traps that are associated with that, as you say?
Yeah, I think it's a good time to get your ducks in a row and get everything in order and think about the upcoming new financial year. So if you're at a point now where you're kind of thinking, oh, I've got the email from the accountant saying these are the things that we need, or that that's coming and you're a bit petrified about where all of your documentation and your data is, it's an opportunity to think, how can I improve next year so I actually take the stress out of this? Because it should actually be a good and exciting time for a lot of people because they realize they're able to bank these deductions and many people will get a tax return. So, of course, you do want to grab all of the information that is pertinent to a property manager and your pay slips or your company statements or whatever it may be, but any expenditure associated with that investment property and ideally classified into the main categories that it falls in. And one thing I wanted to sort of cast the spotlight on is something that the ATO have said at least 4 or 5 years in a row that they're targeting, and that's repairs and maintenance versus depreciating assets. It's something that they just keep talking about. You might remember a couple of years ago, the ATO was saying that we did a sample of property investors and we found that 9 out of 10 of them were wrong. I actually spoke to someone in the tax space who wanted to get some more meat on the bones for that data, and I became very interested, and we bonded over our shared nerdity around data, especially tax data. And that sample size was actually, I think, only around about 400 property investors. So they're trotting that out quite regularly, but it's not a statistically significant sample size. I mean, I'm sure that people are getting it wrong, but I just think that was, it's a bit of a political statement on the part of the ATO. But why are repairs and maintenance important to kind of tease apart from, say, the tax depreciation side of things? Well, repairs and maintenance expenses are better. Like, they're the gold standard. They're the ones that you want. Why? Because whatever costs you incur that are legitimate repairs and maintenance, you get an immediate deduction. So 100% of what you spent comes off the taxable income of the entity that owns the property or what have you. Whereas a depreciating asset needs to depreciate over its life. Now, depending on what that is, I mean, carpet has an 8-year effective life. Hot water systems can be 12 or 15, whether they're gas, electric, or solar. Yeah. So it takes you a lot longer to get that money back. So if you can claim repairs and maintenance, you're getting the upfront cash rather than having to write it off over time. What happens is that property investors get that wrong quite regularly. And the best example, I think, is something like a hot water system. Now, if it has a pump inside it that fails and it costs you $800 to replace that pump, but the hot water system stays in place, well, that's repairs and maintenance. The easiest way to think about repairs and maintenance is that it updates or it brings up to sort of functionality something that remains in place, whereas something that's a new asset or replaces an old asset needs to be depreciated over its life. So if it wasn't a water pump and we had to throw the whole water system in the bin and put a new one in, that's not repairs and maintenance. And if you claim it as such, the ATO has recourse to pinch that money back from you. And that's not a situation you really want to be in. Yeah. No sense of humor, those guys.
Yeah, well, no, absolutely, mate. I think there's a sort of a balance between instant write-offs and depreciating assets as well, because you sort of don't want to be in a situation where you've had a thumping year and it looks great on paper this year, but because you've absorbed it all and that there are any sort of longer-term depreciating assets, that suddenly your holding costs jumps up substantially in the following year and starts to burn a hole in that affordability piece. So I think there's a fine balance here, and I think and we'll again get into this later, but I think with the changes that the ATO instituted a few years back in not allowing fixtures and fittings to be claimed unless they're brand new, effectively, either a new build property or you put them in yourselves, then the holding cost affordability piece that is a big part of the sustainability has really taken a dent. So I think getting that balance right and sort of giving you the breathing space to be able to hang on to the property long enough to enjoy the fruit from the capital growth is a bit of a balancing act as a consequence of that. So that's awesome. Now, I know that one of your sort of favourite cautionary tales is about investors missing big juicy deductions. So I'd love for you to tell us how much is being left on the table and what's the cost of procrastination when it comes to ordering a depreciation schedule, Mike?
Yeah, happy to. And I suppose to segue from the previous point, if we think about all the deductions that are available to us as property investors, of course, repairs and maintenance can be big, hopefully not. I mean, in your intro, you talked about properties that won't necessarily have as big repairs and maintenance bills. You've also got your property management fees. That's easy because they'll be able to give you that ledger, and that should also have the assets that you've purchased over the years. Probably the biggest one is the interest component on the loan, and that's another area where people get it wrong. They'll redraw equity from an investment property and they'll buy a car and they'll continue to claim deductions on that, but that car component needs to be teased out, and investors are getting that wrong quite regularly. But the second biggest deduction is the tax depreciation, and of course that would be a strong tip, is to investigate the deductions that are available to you and don't wait, because as you mentioned, this is a story about the harm in waiting. So what we actually did is we looked at 1,000 residential transactions within our business, because unlike the ATO, we like statistically significant numbers, and 1,000, I don't know if I want them as an enemy, really, but
we might edit that.
we'll lean into it. No, I actually leave it in. I'll go even harder. You only live once. So what we did was we looked at 1,000 residential transactions, and what we found is that 6.7% of those 1,000 people waited so long that they missed out on deductions. Now, what does that mean? Well, you can actually back claim 2 financial years worth of deductions. So if you bought a property 2 years ago, you've never claimed depreciation, our report will start from your ownership time, whether that's the construction completion date or occupancy certificate date, or whether the settlement date, if it's established, and we can actually show you those missed deductions. You can pay a fee to your accountant to amend previous years. But what we're actually saying is that 6.7% of people we identified as waiting more than 2 years to get a depreciation schedule done. And what we did is we calculated the average losses that each of those people in that case came to. And then because we were working with a PR firm and journalists love clickbait, they gave us the red hot tip to extrapolate that over the property investor population, which I think the first time we did it was around about 1.4 million. It's grown by nearly 1 million since then. Yep. But it was actually $20,537 was the average amount. And if you extrapolate that over the investor population, we're talking $2.88 billion worth of deductions. In recent years, we've crunched it and we've had some numbers that drop just into the millions rather than billions. So my pitch to the ATO is I'll stop talking about this for a measly salary of $10 million a year, because I think the education is making a dent. People are understanding it, but whether it's 2.88 billion or whether it's 900 million, it's still way too much. This is an entitlement that a property investor has. I mean, this is not a dodgy little loophole. This is tax legislation. It's baked into the Income Tax Assessment Act of 1997. It's law. It's something that you're able to do. And if you think about it, you are actually providing a service. I sort of ran a little bit of a thought experiment. The government is really out of the public housing business. There's been no meaningful increase in public housing for a decade. And we're talking 300,000 homes. There's around about 11 million dwellings in Australia, and a third of those will be rental properties. So we're talking 3 million dwellings, not 300,000. Now, Every now and then we hear politicians talk about the cost of negative gearing. The last year we actually got those numbers. It was actually zero cost because it was a couple of years ago. It takes a while for the data to come in. So there was actually zero cost to the government in negative gearing because interest rates were at their emergency lows. But if you look at it over a longer time frame, we're talking about $3.6 billion worth of negative gearing losses. However, if you take property investors out of the mix, the value of, say, a median house price of, let's say, 750K, we have to buy a third of those 11 million dwellings as a government to provide that rental accommodation to replace the investors. I ran some quick figures and it worked out to be about $2.4 trillion, not 3.6 billion, but $2.4 trillion. So property investors are performing a very necessary service. They are providing rental accommodation. Now, people may argue with me, oh, well, if you just took all the property investors out, then everyone would be a first home buyer. But that's not actually the case. You can go back around about 75 years and see that around a third of people always rent. Might be because they've immigrated and typically they wait sort of 5 or 6 years to buy a property because, imagine going to a place you don't know anything about, but you're like, I definitely want to live here for the rest of my life. Or you might have people that are on unusual contract terms with their work, or, they could have a disability or a million different reasons why they aren't going to qualify for a loan. So I always sort of say to people, these are your entitlements and claim them. And if you feel funny about it, then get the deductions and give it to charity. Don't give it to the government because they're just going to waste your money.
Beautifully said. That's absolutely beautifully said. And I mean, there's so much to unpack in what you've just shared there. But if we sort of boil it down to the individual level, if the average is 30 grand that you've managed to pick up from a 2-year revision of what they haven't claimed, that's legitimate. And if you're not claiming, you need to kick yourself because you're actually costing yourself money. The 30 grand, that's if we look at that over a 12-month period, that's equivalent to $600 a week, which is probably going to pretty much wipe out a big chunk of the costs from that affordability piece again. And I think the point you make there is a very good one because let's face it, about 90% of rental housing is provided by, I still call them mum and dad investors, so there might be other terms for it these days, but the very reason those incentives were instituted back when, if we go back far enough, was because the government knew that it was getting out of the provision of housing, and the only way that they could do it was to incentivise private investors to keep adding stock and to provide that 30% need that's been there forever. But also, I think what's forgotten with all of this as well is the other ripple effect that if people are actually investing in property, one, to provide housing, but two, to help secure their financial future, there's going to be a less burden on the welfare part of the cost, that less reliance on government pensions, less reliance. So if we look at the true picture of what is being benefited by private investors actually continuing to do that, not only to satisfy rental, but also to put themselves in a better position long term, holistically, why would you change what's not broken? I just, again, don't start me on this subject, but it just never ceases to amaze me, Michael. And perhaps it's because mum and dad investors are, there's no lobby group for mum and dad investors, so they're an unspoken audience. It's almost a silent majority, and therefore it's very easy to pin the tail on the donkey and use them as a target that the media and the politicians like to have a kicking bag and the donkey to pin the tail on. But I think it's, if someone at some point who's not trying to score political points actually sits back and has a think about it, there's not too much wrong with what's actually happening. In fact, I would go as far as saying that we need to further incentivise investors because they, I think, are a big part of the solution to this housing crisis the media keeps us top of mind on. But,
well, you've only got to really look at rents, right? My friend Peter Kalisos ran a research project where he looked at 25 years of rental performance or rental growth and found that it underperformed inflation across that period. So when we're talking about a rental affordability crisis, I mean, over the long term, it doesn't exist. It's just that pace of change that we saw where, rents were growing double digits, right? But that kind of coincided with a landlord exodus. We saw a lot of investors getting out of Victoria. We saw land tax legislation come in Queensland that was ultimately repealed. And we can see in our own data that the percentage of people buying in Queensland as distinct from other states dropped about 17 basis points. So, yeah, like I agree. And I think I remember a Victorian Housing Minister asking a PIPA panel, like, what do we need to do to incentivise investors to get back in? And the consensus was really just stop the disincentives, and stop the scapegoating, right? I mean, these are people that are just trying to take their own financial future into their hands. And as far as I'm aware, welfare is still the number one line item for expenditure for the Australian government. Of course, there's more to it than just pensions. That'd be a smaller part. But these people are trying to unqualify themselves from the pension, right? So let them do that. And not to mention the spin-offs of industry. I mean, when people are getting a little bit down on mining likes to talk about the percentage of the workforce that they employ, but it can't hold a candle to the property industry. And the governments are kind of in on this themselves. The state governments combined, we're talking about $1 billion a week in stamp duty revenues, not to mention, the local council, development application contributions, the land taxes, all those sorts of things. So it's a big money spinner for governments as well.
Yeah, very good point. Very good point. That's a topic that we'll dig into at a later date, I think, Mike, because I think within that, if people are serious about the housing affordability, supply, rental crisis, really embracing investors as friends, not foes, is going to be a big part of that. And using a lot more carrots and a lot less sticks, I think, is definitely where it needs to be. On a sort of a going sideways for a minute now, there's this age-old misguided myth that keeps getting peddled around that about the impact of depreciation on capital gains tax. So I'd love for you to dispel this for us once and for all, if you can, please, and outline the benefits of actually claiming deductions now rather than deferring them until later.
I'd love this to be the once and for all answer to CGT and tax, because it's been following me around my whole career. And typically, I mean, this gives you a bit of an insight into the type of person that kind of talks about this and worries about it. Typically, it's heckled at me at the end of presentations, like this sort of a disgruntled person that sort of says like, oh, well, that's all very well, Mr. Mortlock, but, you've just got to pay it back at the end anyway. So the whole thing is moot. So there's a misconception about it. And technically, it kind of falls into accounting advice. So quantity surveyors had sort of not maybe handled this question well in the past, partially because they're kind of worried about overstepping and giving financial advice. But what people are saying is that if you claim depreciation deductions, that when you sell the property, you've just got to pay that back because it gets added to your CGT bill. And that's only partially correct, and it ignores a couple of really important things as well. So what actually happens is, let's say you buy a property for $1 million and you own it for 2 years and you sell it for $2 million. I mean, forget that being like a great property and people calling you saying like, where do we get that one that Mike was talking about that grows $1 million in 2 years? These are just simple numbers. But let's say over that 2 years, you're claiming $50,000 a year worth of Division 43 capital allowances. So the building structure sort of stuff. So what that actually means is that, okay, we add that together, there's $100K of claim there. What it actually does is it reduces your initial cost base. So instead of the gain being $1 million to $2 million, so $1 million, it's actually going to be $980,000. To $2 million. Did I get the math? No, that's wrong. But you take the 100K off the front. So you got 900,000. Not, I was thinking 20 rather than 100, sorry. So you got 900 as a buy point and then 2 million as a sell point. So instead of making $1 million gain, you're making that $1.1 million gain. So what you might have picked up on then is I talked about Division 43 capital allowances. So it really only looks at the structure, not the plant and equipment items. Now, there are all sorts of tax nuances where if you sell the secondhand assets for something at a contract value, you can have balancing adjustments. But for most people, they only really need to look at the structural stuff.
Yep.
And then we say, okay, well, I've claimed those deductions, but when I sell it, I have to pay it back. Well, that's wrong as well, because if you own an asset for 12 months or more, you have the 50% CGT exemption. So instead of that 1.1 gain, you're now only actually at 1.05 gain. So we're halving that, right? And the same happens for the asset itself. You're not taxed on that $1 million gain. You cut it in half, so it's only 500K. So it's 550K. So you're not paying it back. At worst, you're paying half of it back, and it's only maybe half of the deductions. If you're buying, let's say, a new house, you don't have to worry about the plant and equipment deductions, which could be easily half of the total value of a depreciation schedule. The one thing that I think people miss the most is the consideration of the time value of money. And you could probably add on top of this the impost on holding an investment property and where that is the most painful. So I'll start with that one. The hardest time to hold an investment property is the day that you buy it. Yep. It should, over time, get easier. You might kind of think, all right, well, maybe my salary will go up. That can happen. That's not where I'm sort of thinking, though. Yeah. Over time, the rent will increase. So what actually happens is that you have to pay X a month for the interest bill. The rent's, maybe looking after 80% of that. But over time, that'll go up to 81, 82, to the point where it can be cash flow positive. So that's important to consider, that you really need the cash flow help at the beginning. Later on, it's not important, especially if you're paying down some of the principal, which some investors will do as well. So the balance is dropping, the rent's going up. Both those things in concert are making it easier for you to hold the asset. The other thing is just generally the time value of money. So if you're a sophisticated investor, you are investing over a long time horizon. You aren't in there to get that 12-month sugar hit. You are there to hold that property 10, 20, 30, 50 years. Maybe you will actually never sell that asset. But let's just say you buy an investment property and you claim the deductions, and then in 20 years you sell that property. Now, I think not to pick on you, Bushy, as the silver fox of this chat, but I'm old enough to remember being sent to the shops with a 20-cent coin or a 50-cent coin to get a bag of lollies. That doesn't happen anymore. The best time to own $1 was today. Better than that was yesterday, and better than that was a year ago and 10 years ago. The impost of actually having to repay a fraction of that dollar in 30 years' time is so negligible that it brings the whole thing into, I think, a focus that people are just zeroing in on the wrong things. I think it's a glass half empty and the glass has got a hole and we've ran out of glasses type attitude.
100% agree. And that sadly, Mike, I'm old enough to remember being able to buy a bag of lollies for 1 cent.
Oh God!
So you do the maths on that. I won't spell it out for you. But I think the really important thing there also, and again, I'm not an accountant, don't pretend to be, but we certainly get investors to work with their accountant, because anything that we're saving from a depreciation perspective, if that's then combined with a PAYG withholding tax variation, so that rather than get, say, 10 grand back in a big lump at the end of the year, you're getting $191 that every week effectively, and the savings of that is allowing you to effectively pay down your non-deductible home loan using the savings that comes out of that. Then not only are you getting an appreciating asset that's costing you less to hang on to, but you're also making a big hole in getting freehold ownership of your home back a lot sooner than what you otherwise would. So I think there's a whole bunch of interrelated benefits of really grabbing depreciation by the horns and squeezing as much juice out of that lemon as you can, as quickly as you can, for all the reasons that you've so well explained there, mate. So now I want to sort of switch gears again a little bit, if I can, into something that I touched on in the intro, and you know, let's face it, I used to be an architect, so I'm very comfortable with the whole building piece. But as an investor myself, once I'd learned the ropes and got the hang of the exercise, there's no doubt that if you, like the example I painted, built two properties side by side, bought an existing one, an old one, and built a new one, and providing all of the other growth drivers are associated with it, I would build every time because there's all of the depreciation benefits, the stamp duty savings, there's the less maintenance, there's a whole bunch of stuff that goes with that. But if we look at that sort of new build and existing debate, I'd love to get your read on how that sits, because I guess I get a bit frustrated with buyers agents and others who excuse my French, shit can the new build process. And it's easy to point the finger at apartments and off the plans and all of that stuff, but that's fine. But an infill property that's built with all of the right things with it, I think is I would do that every day of the week if I had the opportunity. What's your read on all of that?
Yeah, look, I think I'm probably guilty of sort of throwing new in the same category as off the plan apartments, and I think a lot of sort of commentators are of the same kind of, you know, fallacious reasoning in a sense, because what we care most about is protecting consumers from the spruiker, right?
Cool.
Spruikers exist everywhere. They tend not to exist in the established space, whereas in the new space, of course, there are products that are built by developers, and there's a whole industry of agents that will sell these things to people through their network as an accountant or a financial planner, or just because they're a big sales funnel, and then they'll clip the ticket from the developer. You know, that kind of inflates the value of the asset. And many of these things, there's just some really shiny research papers about how great an investment this is, but it's just all about sales, right? Yeah. So I'm definitely guilty, because I remember having someone on my podcast some years ago that was kind of in the space of new builds and specifically houses where the locations are prime for growth. And she basically kind of was surprised that I had her on the show, because she kind of thought I was just anti-new. I'm not anti-new at all. I'm anti-spruikers. So I've certainly made the mistake of kind of chucking new into that bucket. Where I don't like new property is in high density, for example.
Yeah.
So if it's an apartment complex of 200, if your property's for sale, you might have two other listings to compete with. If anyone is compelled and it's not, a proper arm's length transaction, the valuer should exclude that, but it's very hard to do in real time. So these precedents are being set that affect your value. If you've got a tenant in there, there might be 8 properties that are available for rent at that particular time, and it ruins the scarcity sort of thing. But I know what you're talking about is houses. And when I talk about houses, what I hate is the big mass subdivisions, the green fill. Like, we've taken a paddock, there's 10 other paddocks like it all around it. So there's nothing that's kind of speaking to scarcity. It's like, if I'm buying this, there could actually be something built next year that's newer than mine, and there's another 400 of them going in. So it really kind of forces the pressure down. Yeah. But when we're talking about new versus established, with everything else being equal, it's a location where there's a diversity of employers. There's all sorts of metrics, and we could do a whole nother episode on what they might be. Yeah. New versus established side by side. I mean, you highlighted it in the intro, like, new is a lot easier to look after. Your repairs and maintenance bill will be a lot less. Your tenants are more likely to look after the property because it comes in a mint condition. Whereas if you give them a tired, established property, they'll be like, well, if you don't care about it, I'm not going to. the property managers are more interested in renting these out. And you would kind of think, well, I'm paying them a fee. They should just give me a proper service. But that's not exactly how the world works. You're going to attract a better quality of tenant. And of course, the tax depreciation deductions will likely blow it out of the water. Now, I have some quantity surveying colleagues that I've heard say, like, new property is better for depreciation than established, and just kind of leaving it at that. Well, you can't, like, I'm a details guy, and you can't just say that, because let's say a brand new project home and you compare that to a property in Paddington that's just had a $2 million renovation done on it, it's going to have way better deductions than a brand new property. But again, we're not talking about that. We're talking about like say a 1980s build property compared to a new one. The depreciation deductions are likely to be 4 or 5 times better. And as we've kind of highlighted, it's difficult to hold on to a property in the beginning, and that is part of the secret sauce that really kind of feeds into those new properties being good when they are located in those areas that have scarcity, and they're exposing themselves to all the drivers that an established property would.
Absolutely spot on. And we run numbers on this all the time for our investors, because we like to build stuff out on paper before they even start thinking about the bricks and mortar side. And we'll do comparisons between a property, an existing property in a trust, in joint tenants in common, and we'll do the new build comparison, assuming everything else is the same. Not uncommon on a sort of a $650,000 property, if you're building the same thing with the benefits that we've weaved in now, and this net after tax, it's up to $200 a week difference. Now that's pretty significant for someone who's holding onto a property long term. So this is why I think there needs to probably be a bit more balance in the equation with this. And yes, it's very easy to target the greenfield stuff that's in thousands or apartments and the off the plan exercise. But if you drill down a little bit further, providing you can carefully control cost, time, and quality, then I would build every day of the week. And it's certainly been challenging in recent times because of what's happened to the construction industry with the lack of the trades and the costs going up. But that's starting to settle down from what I can see. And that's probably a perfect segue, really, Mike, to get your thoughts on the construction cost side of things, because as a QS, that's something you're looking at all the time. What are you seeing in the industry, and what is happening with costs as it currently stands?
Well, the story of costs really probably starts during the pandemic, right? So we saw material input prices basically jumping 33% straight away. So at that point in time, there's actually an index that you can follow. I think it's called the Freightos Baltic Index, just if you want to ruin your Friday night. And that tracks the cost of moving a shipping container around the globe, right? And if you look at that, you'll see this disgusting spike in costs for that, because, just like everything that we know, logistics globally became a huge problem. The majority of our materials aren't domestically produced. We have supply of timber and those sorts of things, but lots of that cabinetry stuff will come from places like China. So straight away that became a problem for us. And so if you look at the data now, I mean, the pace of growth has slowed quite a bit. I mean, a recent print, I think about 6 months ago, was the slowest since about 2002. So construction costs aren't growing rapidly, but we're just still dealing with that hangover, because the costs went up and they aren't going back to what they were. They're not rising as rapidly as they were in the past, but we're from a high base. Now, material prices have certainly come back and moderated, but the problem now is shortages. Now, that's a shortage of skilled labour and tradies. They are gone for a number of reasons. We're seeing a lot more apprenticeships not actually go to fruition. There's some horrifying stats about the amount of apprenticeships that start and actually finish. And there are other things that are pulling trades away. So we've had a huge pipeline of national infrastructure. if you look at any city around the country, you'll know there's big projects. So we've got, Western Sydney Airport, we've got the rail loop in Melbourne, Queensland. We've got, of course, some of the Olympic stuff, but also the rail to Sunshine Coast. There's just project after project, and a lot of that was kind of government stimulus. But those jobs typically will take trades away from the people that build homes, because they typically will pay a lot better. And what pays even better than that I think is part of the equation that people don't necessarily think about, is the natural disasters and the rectification works on the back of that. So, I mean, we've still got hangovers from the bushfires many years ago. I mean, we've just had most of Queensland underwater.
Yep.
I've spoken to top 3 national volume home builders saying, I can't get roofers. And, I say to them, well, that seems a bit weird. Like, surely it's a golden ticket for a roofer to be working with your business because you've been around forever and you're building so many. And they said, well, yeah, normally, but when they're getting 3 times the hourly rate doing insurance stuff, they're not picking up the phone. Because when you think about insurance, it's not just fixing the damage. You actually have to rehome the people that live in that property, which has a very, very high cost if you're putting them into hotels or Airbnb and that sort of stuff. So those things have conspired against us. And now we've also got the issue of a sea of liquidation. So the construction industry is number 1 for insolvencies and liquidations of any other business type. And to give some context on that, if you think about the beginning of the pandemic, I kind of joke about this, but we didn't really know what was going to happen. We didn't know if half of the global population would be deceased by the end of it. Like, I mean, these were serious conversations. I mean, we have the benefit of hindsight now where we know we go, okay, well, it wasn't anywhere near as bad as what we thought. But of course, many people lost their lives, so that shouldn't be trivialized. But we were kind of thinking, like, do we need to buy canned, foods and batten down the hatches? Do we need to get a crossbow? Are there going to be zombies in the street? We certainly need more toilet paper. I mean, have you seen the toilet bill? Get out there and get some more toilet paper. I mean, that was a very serious time. I remember writing a LinkedIn article saying the mechanics of toilet paper supply in Australia, and I thought, this is the weirdest thing I've done in my life. And I've done a lot of weird things, Bushy, I can tell you. And with toilet paper, that's a different story to, say, construction materials. Like, most of the toilet paper supply comes from domestically, but it's a just-in-time model. So they don't store mountains of this stuff because it's so big and bulky. It arrives, it gets sold, and hopefully that all happens within hours rather than days, and days within weeks. So if we all just behaved normally, there was no problem. But we didn't behave normally. We went mental, which is kind of funny now to think about. But, I don't know, there's probably lots of tissues and paper towel being shoved down the toilet over that period.
Very much. So the interesting times in that regard. I guess the obvious flow on from what we've just talked about then, given the sort of much media maligned housing supply crisis, particularly in relation to progress on Labor's National Housing Accord and the target of building 1.2 million new homes by what was 2029 and sort of now magically become 2030 for some strange reason. And what's your read on where we sit in relation to that and what that all means to us?
Yeah. Just to finish the toilet paper point that I just lost control on that one. What actually happened is builders locked in a pipeline of work to stay solvent, just to trade through it. And if they were doing it at a 5 or 10% margin just to keep treading water, construction costs, if they go up 40%, there's these projects that maybe, have a 2-year timeline that they know are locked in at a loss. So we had people calling us saying, the builders sort of saying, I need X money to finish this off, but it's a fixed price contract. What should I do? And a lot of the time our advice was, you need to probably play ball and come to the party, because the result is that they could go under, and that's a way worse outcome. So that's the liquidation story. But if we're talking about Labor, it actually started 1 July last year, 2024. That's when they said it. Now, you and I are going to keep them honest on that. But they basically said, we want to build 1.2 million homes in 5 years, or we're going to build 1.2 million homes. And My first comment was, well, you're not going to build anything. Like, you're the government. Like, you're not in the construction game. You're relying on people to build these properties, right? Like builders and developers. And let's look at those numbers. We've only ever done that pace of building once in history that I'm aware of. They said this at a time of high materials costs, labour shortage, and quite high interest rates. Maybe not historically over the history of Australia, but it was higher than it is now, and we're all kind of thinking it's high and it needs to go down. And in that environment of so many insolvencies. So I was just sort of saying it's over before it began. But if you look at Q4 last year, which is kind of the last quarterly read that we got, we only had 41,900 homes commenced. So that's just over 18 grand short, or 30% short of that housing target. And, so 41,900 and par is 600,000, and only 168,000 commenced construction during the year to Q4 2024. So again, about 30% behind. Those are big numbers. And we did sort of see international migration curtailed at the back end of 2024, but that was kind of just a little bit of a blip. Immigration is still a big thing. Yep. Population growth is about 80% represented by immigration. So that's the real driver, right? And we just aren't building enough to even house those people, ignoring an existing construction crisis. So it's not going to happen unless something bizarre changes or there's some new policy that fixes this. I mean, even if there was a new policy to say that, all builders got a Lamborghini, we don't have enough builders. We can't train them quick enough to do this, right? And I mean, that's a bizarre policy, but now we've got Greens holding power in the Senate. We should be maybe getting used to bizarre policies.
Get ready for it, yes.
I'm going to be in trouble with the ATO and the Greens now, but I don't really care.
Thank heavens Max Chandler disappeared, mate. He was a fairly scary individual in relation to some of his radical ousts on the whole exercise. But I've seen, and you would have read them more than I would have, but the Property Council and the UDIA have all come out with reports suggesting we're anywhere between sort of 460 to 390 odd thousand short over that 5-year time frame. So clearly there's going to be some challenges there. And I've heard others say that if we were serious about the housing affordability crisis, which is, there's a supply crisis, but then there's the affordability crisis, we'd need to be building at least another 1 million new properties over and above that. So I guess while that's sad for people who are going to struggle, the flip side of that, for investors who are already into the market, it's actually all good news, because it means that with that scarcity going to continue on top of the, as you say,
absolutely,
migration pouring in. There's very limited supply, very strong demand. There's only one way values are going to go, which is good news for people who are holding on to property long term. So look. We could talk for hours on that subject. Let's take a quick break here, Mike. And when we return, we're going to sort of broaden our discussion into other important, but quite often less talked about topics like risk insurances, the market movers that we touched on, the media impact on sentiment, and some of the post-election property impacts that we've just sort of touched on then. But before we close on Mike's view of all of that, we're going to make sure we also get his crystal ball on what's likely to happen. So don't miss it, and we'll see you on the flip side.
Thanks for tuning in to Get Invested on the Property Hub podcast channel, your home for property investment insights and inspiration. Make sure you subscribe to Property Hub for free. Get your weekly dose of Get Invested inspiration, along with every episode of Realty Talk, Australia's top online property show for red-hot property investing news and insights direct from industry leaders and influencers. And finally, I'll see you next time.